A great deal of attention is paid to Warren Buffett each year following the conclusion of his annual Berkshire Hathaway conference. Many people believe that Buffett is the greatest investor in the history of the world. Throughout the entirety of the event, each and every comment that he makes is meticulously scrutinized due to the extensive monitoring. This year, the themes that received the greatest attention were the massive cash reserves held by Berkshire and the potential consequences those reserves could have on the economy as a whole. Buffett's cautious approach to investing his enormous cash holdings is regarded by many observers as an indicator that he's preparing for a significant economic downturn in the United States. The concept that an experienced investor like Buffett would not find sufficient value in the market if he's reluctant to spend his cash reserves lends credence to this impression. Buffett is an example of an exceptional investor. By way of illustration, Buffett's Berkshire Hathaway has been carrying more cash than it ever has before, which amounts to more than $189 billion. Concerns have been raised over Buffett's outlook for the market and his strategy for dealing with potential economic challenges in the future as a result of this extraordinary cash stockpile. Some commentators believe that Buffett's amassing of cash is a sign of his pessimistic view, which suggests that he's getting ready for a market slump or possibly a recession. This viewpoint is supported by the actions that Buffett has taken in the past, which more often than not involves utilizing his cash reserves in order to make intelligent wagers during times of market volatility. Buffett's investment philosophy, which has shown to be highly successful over the course of time, is characterized by a number of fundamental components, including value investing and a long-term approach. Berkshire Hathaway's shareholders have reaped enormous benefits as a result of his ability to correctly identify low-cost enterprises and to make intelligent acquisitions. His current cash holdings, on the other hand, have raised questions about whether or not he's anticipating a significant shift in the economy or whether he is simply anticipating events in the market. In spite of the fact that Buffett has not explicitly stated that he's of the opinion that a serious economic collapse is imminent, the speculations have been fed by his words and actions. There are a lot of people who are curious about what Warren Buffett thinks about the market as a whole and whether or not he feels it's an overblown bubble. This is because Berkshire Hathaway's cash reserve has grown to an astonishing $189 billion. According to observers, the sheer size of the companies that are featured on the S&P 500 index makes it harder to allocate attractive investment possibilities. This has caused them to express their concerns. The magnitude of Berkshire's financial armament, which was previously unheard of, is effectively illustrated by a figure. When it comes to explaining this huge increase, current cash yields are a compelling rationale that is commonly put out. To understand what Warren Buffett truly means when he talks about his cash position of $189 billion, it's essential to understand that he's referring to cash equivalents, which are primarily in the form of short-term United States Treasuries investments. In spite of the fact that it may appear to be a complicated distinction, the most important thing is that these holdings must provide a yield. Bonds issued by the United States Treasury with a maturity of 3 months offer a yield of around 5.4%, making them an intriguing and secure investment option. In spite of this, Buffett clarified any misunderstandings that may have arisen during the most recent conference. He emphasized that he would continue to keep the same level of cash reserves, even if the yield were as low as 1%. Instead of focusing solely on maximizing profits, this suggests that Buffett's motivation originates from the fact that there are not many attractive investment opportunities available. He made it abundantly evident that none of the individuals who were sitting at the table had any constructive ideas regarding how the money should be utilized. When he stated that a market crash would be necessary to restore the market back to its previous level of undervaluation, given that he believes it is overpriced, he reiterated the stance. He believes that the market is currently expensive. The fact that he is unwilling to make investments is, in essence, an indication that he believes the market is now expensive. Despite the fact that Warren Buffett might not express this sentiment directly, many observers see his actions as a sign that he is anticipating a potential decline in the market. Buffett introduced an important indication in 2001 that is now generally known as the Buffett indicator. This signal was meant to be used for the purpose of evaluating the overall value of the equity markets in the United States. For the purpose of shedding light on the connection between economic output and market value, this statistic compares the gross domestic product of the United States to the total market capitalization of the publicly traded firms in the country. Based on the study of the indicator, any major difference that exists between these two components is readily apparent. Buffett asserts that the Buffett Index is probably the best single measure of where valuations stand at any given moment. which highlights how essential it is to take into consideration while evaluating the conditions of the market. Considering that the Buffett indicator is currently at 199%, it can be concluded that the markets in the United States are overpriced in comparison to the averages of the past by almost 2 standard deviations. There is a risk that there will be an imbalance in market pricing as a result of this very big departure from the norm. During times of market exuberance, for instance, the Buffett signal would have shown high market valuations in comparison to economic fundamentals. This would have occurred during the dot-com boom that occurred in the late 1990s. It's important to note that this historical context highlights the value of the indicator in identifying potential market distortions and signaling instances when the market is in excess. The current reading of 199% is not only a dramatic illustration of the increased valuation levels of the market, but it also highlights the necessity of exercising prudence while making investment selections. The market has virtually always experienced significant falls once the Buffett indicator has reached this level. This has been the case throughout history. This historical trend brings to light the potential gravity of the current market crisis that is now taking place. A distinct approach is used by Berkshire Hathaway and Warren Buffett, in contrast to the approaches taken by many individuals working in the financial business who attempt to forecast recessions. The fact that they are unable to predict when economic downturns would come is something that they openly and freely concede. Nevertheless, their historical performance demonstrates that they have a solid understanding of the values of the market. It is more important for them to recognize instances in which assets are overpriced than it is for them to speculate on the precise moment. The notion that market forces will eventually make these disparities right, so offering possibilities for astute investors, serves as their driving concept. For instance, during the dot-com boom of the late 1990s, Berkshire avoided investing in technology stocks, despite the fact that the market was experiencing considerable enthusiasm. The well-known comment that Buffett made was that he didn't have sufficient knowledge about technological businesses to ensure that he would not invest in them. Berkshire was able to avoid suffering significant losses when the bubble burst in the early 2000s, thanks to Buffett's ability to identify overvalued industries and gradually deploy money. In a manner that is analogous, Buffett maintained a cautious stance in the face of an overwhelming optimism in the housing market during the global financial catastrophe that occurred in 2008. Despite the fact that some individuals made substantial investments in risky financial instruments and mortgage-backed securities, Berkshire continued to concentrate on developing long-term competitive advantages in industries that were fundamentally stable. Berkshire was in a fantastic position to profit from damaged assets as the crisis developed, and it was able to purchase attractive investments at substantial discounts for these distressed assets. The fact that Buffett has recently shown reluctance to spend Berkshire's substantial cash reserves in the midst of the present market frenzy is evidence of his dedication to this conceptual framework. Buffett demonstrates discipline in the face of low interest rates and investment pressure, patiently waiting for opportunities that match his requirements for long-term investing. This historical context sheds light on Buffett's cautious investment technique, which is founded on his ability to recognize market overvaluations and his patience in waiting for favorable circumstances to arise. Despite the fact that Warren is unable to specify the exact moment or location of these market corrections, he is aware that the current conditions are uncommon and will most likely undergo rapid change in the future. In a recent chat, he voiced a position that best reflects this viewpoint when he said, "It's not like I'm on a hunger strike or anything. It's just that the current landscape lacks attractiveness, and there are avenues for change that we'll monitor closely." This view is the finest example of this opinion. It appears from his words that he anticipates that things will undergo a transformation. Looking beyond the obvious, you'll notice that he's of the opinion that the stock market is significantly overpriced, which is a viewpoint that is supported by a number of indications. Consider the yield on the 10-year Treasury note, which has proven to be an accurate predictor of economic downturns over the course of the past half-century. Over the course of more than 630 consecutive days, it has been inverted, surpassing the previous record that was established in 1978. The occurrence of an inversion, which occurs when the interest rates on short-term bonds are greater than those on longer-term bonds, has historically been used to forecast the onset of a recession. The presence of these kinds of indications lends credence to the notion that a market downturn might be on the horizon. Investors frequently perceive indications such as the 10-to-2 chart as warning signs of impending economic challenges in the near future, showing a tendency for bigger short-term gains. This is because investors believe that the economy will experience difficulties in the near future. On the other hand, because they're optimistic about the prospects for the long run, they might be willing to accept lower profits on investments that stretch out over longer time horizons. In the past, a downward trend has been gradually indicated by the 10-to-2 chart, which is currently inverted and below zero. Under normal circumstances, recessions do not appear to be imminent until this line returns to a position above zero and stops being inverted. The prolonged inversion of the 10-to-2 chart is a cause for concern, despite the fact that there are no obvious signs that a recession is looming at this time. The chance that a recession is approaching sooner rather than later is increased by the fact that the record for the longest inversion period has been officially broken. At the same time, as investors keep a close check on these metrics for any changes that would suggest a shift in the status of the economy, they also make adjustments to their investment plans in accordance with the new information. Maintaining vigilance and sensitivity to shifting market signals is essential in order to effectively address potential economic challenges in the future. A significant number of Berkshire investors are aware of the fact that Warren Buffett avoids publicly expressing bad comments about the market because he's aware of the fact that it is difficult to precisely foresee financial recessions. In spite of this, savvy investors are able to recognize signals in his statements that indicate a negative outlook with regard to the future. A great number of people may be aware that Buffett holds exceedingly pessimistic viewpoints in this day and age. It is the chief investment officer of Smead Capital Management, Bill Smead, who asserts that this is Buffett's most pessimistic position to date. As he asserts that he's in perfect control, the discussion revolves around the substantial financial reserves that Berkshire possesses, which are approximately $200 billion. When it comes to the employment of this resource, he inquires as to whether shareholders favor dividends, acquisitions, or share buybacks. Despite the fact that he doesn't have any interest in dividends, he acknowledges the importance of operating in a manner that is consistent with Berkshire's core principles and emphasizes the importance of doing action rather than only talking about it. He detects a minor difference at a recent meeting, which indicates that Buffett is intentionally selling Apple stock, and he anticipates a significant outlay of capital in the event that there is a significant downturn in the market. He's under the impression that Buffett is exhibiting severe bearishness. After reflecting on Buffett's stance, he claims that this is the most pessimistic outlook he's ever witnessed someone take. When looking at Buffett's cautious approach to capital allocation, it's essential to assess if this may be seen as a pessimistic outlook or whether it's simply a shrewd response to the excessive market conditions. In order to get a better understanding of Buffett's present position, it's essential to investigate his previous investing strategies as well as his shifting perspectives on the valuation of the market. A transition from a quantitative to a more qualitative approach is one of the distinguishing characteristics of Buffett's investment strategy. After having been heavily influenced by Ben Graham's quantitative notions in the past, he began to be more and more influenced by Charlie Munger's qualitative approach in the year 1969. Buffett made this adjustment after coming to the realization that it was not enough to just buy inexpensive stocks based on quantitative measures. Rather than that, he began to place a greater emphasis on purchasing high-quality enterprises at reasonable prices and attaching more weight to the concept of intrinsic worth than he did to quantitative metrics. Buffett has, throughout his career, emphasized the need of exercising self-control and patience when it comes to investing. In the late 1960s, he made a famous remark in which he stated that the quantitative concepts he had been employing were combed and recombed, which meant that there were not many excellent investment chances. The reason that Buffett is hesitant to deploy money is not because he's pessimistic about the future of the market. Rather, it's because he believes that the market is experiencing excessive price levels. According to his recent statements, the current market is expensive and picked over. These emotions are in line with his statements. Not only that, but the enormous size of Berkshire Hathaway makes Buffett's prudent decisions much more apparent. Buffett acknowledges that as the company has developed, it has become more difficult to find investment opportunities that are significant and profitable. For as long as he can remember, he's held the belief that the greater Berkshire has become, the more limited its alternatives become. The fact that Buffett is reluctant to make hasty investments during times of market euphoria is highlighted by this restriction. Examining Buffett's actions provides additional insight into the mental state he's now experiencing. Buffett has refrained from making significant investments or acquisitions despite the huge cash reserves that Berkshire already possesses. Through the use of stock buybacks and other measures that are more modest and deliberate, he's decided to replace it. Buffett's notion that money should be used at the appropriate moments rather than being chased after overvalued assets is consistent with this purposeful technique, which is consistent with Buffett's thought. Further evidence that Buffett anticipates a significant market correction is provided by the deliberate steps he's taken and the recent reduction in the amount of Apple shares he owns. He's aware that markets are cyclical and that periods of overvaluation are typically followed by periods of fall after they've occurred. It's not that he has a pessimistic outlook on the market as a whole. Rather, his actions suggest that he's eager to capitalize on opportunities that arise as a result of market downturns. The conservative capital deployment method that Buffett employs is mainly a reflection of his absolute commitment to fundamental investment principles and his realistic assessment of the current market conditions. As opposed to taking a bearish attitude, it might be understood as a rejection of the idea that the current market presents attractive prospects for investment. By adhering to his long-term investment approach and waiting patiently for favorable circumstances, Buffett is committed to preserving and expanding the wealth of Berkshire Hathaway over the course of time. The volatility of the economy has historically followed cyclical patterns, which frequently resulted in recessions and market corrections. It's possible to gain valuable insight into the possible factors that led to Buffett's action by conducting an analysis of case studies such as Germany, Japan, and the interwar years, in addition to more general historical occurrences. The Marxist economy theory can be used as a lens through which to study these periods of economic volatility. Marx contends that the basic contradictions that are inherent to capitalism are the root cause of the recurrent crises of low consumption and excessive production. In many cases, these crises manifest themselves in the form of economic downturns or recessions, which are characterized by a decrease in the prices of assets, an increase in the number of people who are unemployed, and a decrease in production. An excessive amount of speculation in the stock market and the real estate market propelled asset prices to levels that were not sustainable, which finally resulted in a harsh correction and a prolonged economic stagnation. In Japan, for example, the bursting of the asset price bubble in the late 1980s caused a prolonged period of economic stagnation that became known as the Lost Decade. The inability of the Japanese government's reaction, which was characterized by fiscal stimulus and loose monetary policy to promote strong economic recovery, brought attention to the challenges that are associated with managing economies that have experienced a bubble. In the years between World Wars I and II, Germany experienced a period of economic turmoil that was comparable to that of the Weimar Republic. The efforts of the government to finance wartime expenditures resulted in hyperinflation, which resulted in the destruction of the value of the German mark and damaged trust in the nation's ability to maintain a stable economy. Consequently, the political instability and social discontent that ensued set the ground for the formation of radical political movements, which in turn brought about the tragic impacts of World War II upon the world. By taking a closer look at bigger historical trends, such as the Great Depression that occurred in the 1930s, it is possible to see that economic crises tend to occur in cycles. The crash of the stock market in 1929 was the spark that ignited a global economic crisis that was characterized by widespread unemployment, the bankruptcy of banks, and deflation. It took years of government engagement and stimulus programs, particularly Franklin D. Roosevelt's New Deal measures, to bring back economic stability and confidence in the financial markets. This was necessary in order to bring back economic stability. Moreover, economic instability and crises were not uncommon in the communities of the ancient world. Exogenous shocks have the potential to disrupt global economies, and the oil crisis that occurred in the late 1970s is a current example of this phenomenon. As a form of punishment for Western nations' support of Israel during the Yom Kippur War, OPEC imposed an oil embargo, which resulted in the quadrupling of oil prices and stagflation in a number of Western nations. The subsequent economic downturn brought to light the vulnerability of wealthy nations to shocks to their external supply and highlighted the significance of energy security and diversification as two of the most important factors. Taking into consideration the aforementioned historical instances and economic concepts, it appears that Warren Buffett is acting in a manner that is appropriate when it comes to the utilization of Berkshire Hathaway's cash reserves. Putting up a sizable cash reserve may be an indication that investors believe the market is overvalued and is likely to experience a decline in the near future. Maintaining his liquidity and flexibility allows Buffett to capitalize on opportunities that arise during times of market instability, such as economic recessions or downturns. This allows Buffett to profit from opportunities that arise. However, it is of the utmost importance to acknowledge that predicting the beginning and length of economic downturns is a task that is extremely challenging by its very nature. Despite the fact that they are able to provide valuable insights into market values and potential risks, indicators such as the 10-to-2 yield curve and the Buffett indicator are not perfect forecasts of future economic events. When conducting an analysis of Buffett's actions, or lack thereof, it's important to take into account his long-term investment philosophy as well as his techniques for the creation and preservation of wealth. We're able to gather significant insights into the likely causes of Warren Buffett's prudent use of Berkshire Hathaway's cash reserves by doing an examination of previous case studies, economic theories, and wider historical trends. This allows us to gain a better understanding of the reasons behind Buffett's actions. Buffett's dedication to fundamental investment principles and his willingness to seize opportunities during times of market distress position Berkshire Hathaway for long-term success and resilience in an economic environment that is unpredictable. This is true despite the fact that the precise timing and severity of economic downturns are still unknown. The repercussions of Warren Buffett's genuinely peculiar warning, which cautions against overvaluation and the possibility of a market correction, extend far beyond the investments that Berkshire Hathaway has made. It's a sobering reminder of the risks linked with global financial markets in Europe, where the continent's economic recovery is still tenuous in the face of geopolitical tensions and structural obstacles. Buffett's warning serves as a reminder of these hazards. It's possible that the continent, which is already struggling with the impact from Brexit, the sovereign debt crisis, and poor development, would see heightened volatility and anxiety in the event that a significant market slump occurs. In addition, Buffett's cautious attitude has repercussions for the global economy as a whole, which is a consequence of living in a connected world where economic shocks can quickly spread across national lines. It is possible that the financial markets, which are already unsettled owing to concerns about inflation, central bank policies, and geopolitical upheaval, would experience much more turmoil if Buffett's worries come true. It's possible that this will damage the fragile recovery that's taking place in many parts of the world by decreasing consumer confidence, disturbing supply chains, and dampening the mood of the market. In a situation that is becoming more complicated and unpredictable, Buffett's caution highlights how important it is to effectively manage risk and make prudent decisions regarding one's finances. Investors who are navigating turbulent seas can benefit from Buffett's long-term outlook and concentration on fundamentals because they serve as a timely reminder of the significance of endurance, self-control, and fortitude in the face of market turbulence. Buffett's long-term outlook and focus on fundamentals are valuable guides for investors. Once more, I'd like to express my gratitude to each and every one of you for watching. If you found it enjoyable, I really would appreciate it if you would click the like and subscribe buttons. You can also leave a comment below and tell me what you think will happen in the markets. I'll take everything into consideration.